Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're walking through a clear educational breakdown of two very popular high-income ETF approaches, WPay and YMAX. These funds both aim to generate income, but they do it completely different ways. And depending on your risk tolerance, your time horizons, and how you approach market cycles, understanding the differences can make you a more informed investor. But before we jump in, I got to do a shout out to all of our Patreon supporters, our YouTube subscribers, and now our YouTube members. Welcome to the channel. Welcome back. If you're not part of the community, hit that bell notification, hit that subscribe button, join the party, join the group. We'd love to have you. Also, if you want, it's so simple. With the YouTube members now, you can help support the channel, and we appreciate that. So let's jump into the video. This video is for educational purposes only, and I am not a financial advisor. Past performance do not guarantee future results. Always talk to a licensed financial professional before making financial decisions. All right, let's dive into the high-income ETF landscape. The rise of high-income ETFs. Over the past several years, we've seen an explosion of new income-based ETFs. Investors want yield, whether it's monthly or weekly, bi-weekly. The fund companies have responded with dozens of strategies using options, leverage, and creative wrap structures. In this landscape, there are two major categories that dominate. Those are like the covered call strategies, just like YMAX, which sells call options on a diversified growth portfolio. This approach generates income through option premiums. It provides a more defensive profile and often performs better in flat or slightly declining markets. The other one is going to be a leverage-based strategy, like WPay, which uses 120% weekly leverage on a basket of single stock weekly pay ETFs. This approach relies on capital appreciation, magnifies both gains and losses, and tends to perform better in strong bull markets. Both strategies aim for high income, but the mechanics and the risk profiles couldn't be more different. YMAX strategy. Let's dive deep into this one for you. YMAX has and uses a fund of funds structure, investing in a suite of yield max option income ETFs. This gives it a more diversified exposure across roughly 30 underlying stock positions. How YMAX generates income is YMAX uses a covered call strategy. It holds a growth-oriented portfolio. It sells option calls on those holdings. It collects those option premiums as income. In the result, some upside capture, some defensive qualities during drawdowns, and a potential for consistent income even when markets are flat. This means YMAX can offset part of its downside risk because of the option premiums acts as a buffer in correcting markets. Now let's take a look at deeper into WPay. WPay invests in 15 single stock weekly ETFs from Roundhill, making it another type of fund of funds, but with a completely different engine underneath the hood. WPay uses 120% weekly leverage. This is the core of its design. Here's what that means. If an underlying stock gains 10%, WPay aims for about 20%. Now, if they drop 10%, WPay can fall around 20% as well. This amplifies strategy, and that it means both potential returns and potential drawdowns are bigger. Now, how does WPay generate income? Well, unlike YMAX, WPay does not use options. Its income is tied directly to the portfolio growth, the performance of the underlying leverage positions. This means WPay is generally better suited for strong bull markets, momentum periods, environments where growth stocks trend upwards for extended periods of time. The risk profile, because of the leverage, drawdowns can be sharper, recovery can be faster if the markets bounce back. Volatility is definitely higher, and time and market direction matter more than it does in a covered call product. YPay is newer with a limited track record, which means long-term performance data is still developing. So let's do a portfolio comparison. Let's compare the portfolios side by side. YMAX portfolio, about 30 underlying positions. WPay, 15 underlying single stock ETFs. YMAX, a higher proportion of volatility growth names, while WPay uses an equal weighted package. YMAX is balanced with more stable names, and WPay is designed around managing leverage driven by volatility. YMAX uses an option overlays to smooth market swings, while WPay is more sensitive to sharp market moves. So the key difference is YMAX spreads its exposure wider, offering more diversification, while WPay concentrates its exposure but increases its potential reward with leverage. Now, the risk and performance dynamics. The downside risk. YMAX has a lower downside risk. The covered calls help offset the losses and performs better, as we said, in the flat or correcting markets. WPay is more downside sensitivity, leverage amplifies losses, and drawdowns can be significantly deeper. Now, the upside potential is WPay can outperform in sustainable bull markets. Leverage boost gives that its gain. YMAX still captures upside, but more moderately. Options overriding limits extremely upside, but offers more stability. So the summary, YMAX, balance, defensive, and the potential for consistency. WPay is aggressive, leveraged, and growth driven. Let's talk about yield and expenses. First is doing expenses. YMAX has a 1.28% expense ratio, while WPay has a 0.99%. And they're doing a fee waiver until September 30th of 26. So an apple comparison is a big difference. Now, both ETFs currently show similar annualized distribution levels, 85 to 82%. WPay pays out including about $4.90 across several weekly distribution totals. So you can see the weekly pay in this standout. This means WPay is temporarily cheaper from the expense standpoint, paying out in its distributions. Tax considerations. Both funds include return of capital, ROC, in their distributions, but in different proportions. YMAX mixes income and ROC. WPay historically includes more ROC, making it potential more tax deferred. ROC is not inherently good or bad. It simply reduces the cost basis and may defer taxes depending on the investor's individual tax situation. Tax outcomes vary widely by person, so always consult a qualified tax professional. optimal market environments. Each of these are in different strategy works. YMAX performs best in flat markets, sideways markets, mid corrections, environments and uncertainty and slow growth. Its covered call designs help smooth your ride. WPay performs best in strong upward trend bull markets, months or years of sustained growth, and periods where tech and growth stocks rally sharply. Its leverage amplifies the positive momentum, but also has the increased risk of amplifying downward trends. So let's do a conclusion. Let's bring this all together for you. YMAX provides a diversified portfolio, a covered call income, and a more sustainable is in choppy markets. It's a balanced risk-reward profile. While WPay offers leverage-driven growth potential, high volatility, more sensitive to market cycles, and a structure better suited for strong bull markets. Neither approach is better. They simply fit different market conditions and different investor risks. So basically, guys, if you found this breakdown helpful, leave a comment. Which one do you like better? Do you like YMAX? Do you like WPay? We know WPay is newer. YMAX has a little bit of track history. Let us know where you think is which one's better and which one's worse.